Alright, hi everyone, we're continuing where we left off in the previous video. We just spoke about domestic life policies. We finished off by saying that policies will go into your estate duty unless they're one of the three exclusions. If the person who's receiving the payout was also the person who is making the premiums each month, you can deduct the value in the estate duty of the deceased by those premiums plus interest. I'll show you what I mean by using an example that's coming up now. Some stuff to note: how each of these are valued. So any kind of lump sum is obviously the value of the lump sum. Any annuity you capitalize over the life expectancy of the shorter of the life expectancy and the period of the annuity at 12%. And then this is all going to be less any premiums that you paid plus interest on the premiums at 6%. The good news: you don't have to know how to value that 12% capitalization, and you don't have to know how to do the interest at 6%. Those values will be given to you. Okay, so let's have a quick look at the example. Mr. Black died 1 October 2020. Him and his wife were married out of community property, and as a result of his death, the following insurance policies were paid out. 1. $2.5 million to his wife in terms of an anti-nuptial contract. Mr. Black paid all the premiums. Number 2. $1 million paid to Mrs. Black, once again the wife. She paid all the premiums, which added up to $400,000, as well as the interest, which is calculated at $95,000. And 3. A policy taken out by his partner, Mr. White. They're in a partnership, and that pays out $5 million. Mr. Black did not pay any of the premiums. It was for Mr. White to buy Mr. Black's interest in the partnership. Okay. So now what we need to think about is, are these going to go into Mr. Black's estate duty? And the answer is as follows. The first one, no, because it was paid in terms of an anti-nuptial contract. 2, that was a payment. Okay, it was paid to the wife, not in terms of an anti-nuptial contract. So it does need to go in. But also remember, the wife is the beneficiary, and she's the one paying the premiums. So you can reduce it, and what you'll do is you'll take the $1 million, reduce it by the premiums paid as well as the interest. So the $1 million reduced by $495,000 means that there will be an amount of $505 going into the estate. For the last one, the policy was taken out by his business partner. It was not taken out by Mr. Black. He paid none of the premiums. None of the benefits go to him or his family, and it was used to buy his share of the business. So in this case, it's not going to go into his estate duty. Cool. Some other things that are deemed property: any donations under a donation mortis causa, or donation where the benefit only passes upon death. Now this is going to take us back to when we were in donations tax. Remember we said, anything that you donate in terms of a donation mortis causa, so when you die, or you tell somebody you can have this when I die, those are not going to count for donations tax. They're exempted. So now they are going to count for estate duty. So you treat them as if you owned it just before you died, so it goes in, and then the transfer to the other person happens afterwards. So it's not a donation, it's not going to have the donations tax, but it will still have estate duty. Okay. Any accruals under the Matrimonial Property Act, I wouldn't stress about this one too much. And any property which the deceased was competent to dispose of for his own or for the benefit of his estate. What this means, technically, even if you didn't own something, but you had the rights to do with it whatever you wanted, you get to choose who it goes to, you have the right to use it. An example of this: if you form a trust, you're the sole trustee and the only beneficiary. You donate something to the trust before you die. Well, while you were alive, you had the choice to do with that whatever you wanted. You could give it to whoever you wanted, including yourself. So that counted as you technically owning it. That will go into your estate as well. Cool. Now that deals with everything that is included in your estate. The next bit we're going to look at in section 4 is expenses which can be deducted from your estate. So these are going to reduce the value of everything that gets included. The first one, section 4A, any deathbed or funeral expenses. So any amounts that are spent on your funeral or in preparation, sounds again terrible, but in preparation of you dying, any medical expenses while you're on your deathbed, those kind of things, those can be deducted from your estate. Other things, any domestic debts due. What that means, debts in South Africa. So if you owe anybody money, those can be taken off of your estate. So if you have a bond over your house, let's say, the full value of the house will go in, but whatever you still owe on the house will then be allowed as a deduction. This includes any money that you owe to SARS. Very important. What will often happen is in an integrated question, I would ask you to do the income tax, the normal tax of the person while they're alive. I would then say while they're alive, they did some donations tax, so you work that out. I will then say they died, so you have to do income tax until the day they die. And then you're also going to have to do estate duty. And the amount that you work out for the income tax that you owe upon death will be allowed as a deduction for estate duty. Okay. Also remember, when you die, you're deemed to dispose of all of your assets. So you're going to have all that CGT and everything happening in your normal tax calculation. Then C, any admin costs of the estate. So your estate is going to be run by somebody called an executor. It's the person who's in charge of your estate. They can take payment for it. This could be a professional executor. It could be a member of the family. But those costs and any costs that they incur relating to sorting out your estate are allowed as a deduction. Any expenditure to comply with the Act, so again, anything that you're paying to get the estate wound up. And then E, very interesting, quite similar to donations tax. If you have any foreign assets that you hold, okay, and you held them before you became a resident, or you received them by donation or inheritance from a non-resident, or you purchase them from proceeds out of income from one of the above options, that's not, well, it's going to go in, but it's going to be allowed as a deduction. This is very similar to donations tax. You saw that these were the same requirements for something to be exempt from donations tax. It is the same thing that's going to allow it to not fall into your estate. F, foreign debts are allowed as a deduction, but they're only allowed as they exceed foreign assets which are outside the Republic. Okay, so what this means, you can stick in foreign debts as a deduction, but only to the extent that they exceed foreign assets. Okay, so if you have foreign assets being put into your estate, you can only deduct foreign debts to the extent that they exceed foreign assets. Very, very important. There's certain types of usufructs that will be allowed as a deduction. If you have a usufruct that reverts back to the original donor when you die, that's not going to count because there's no future benefit. Okay, and if you have some kind of an annuity that you were receiving and it reverts back to the donor, i.e. the person who gave it to you, or, okay, remember this has to be charged against property. The property, what that means is that the annuity comes out of property, so pretty much it's rent that's paid to as an annuity. If it goes back to the original donor, it is allowed as a deduction. The other option, if the owner of the property is the same person at the date of donation and the date of death. So somebody gives you this annuity, it's charged over property, and the owner is the same at the date of donation and the date of death, you can allow it as a deduction. This is getting very technical. I don't think we're going to go into that much depth, but you do need to know it. At the same time, if you leave anything to a registered PBO, that is allowed to be deductible. Okay, that means that the value of any of those assets would have gone in as property. They can come out as a deduction if they are given to a PBO. Some more, again, some of these are a bit technical. Any improvements made to property by beneficiary under consent of the deceased. What this means is, if there was an improvement made to some property that goes into your estate, it was made by the beneficiary, so the person receiving it, but you gave them permission to make those improvements, it will go in, but it will then come out. Okay. I wouldn't worry too much about J. To be honest with you, you need to know it's there, but I'm not going to worry about it. IA, any accrual claim of surviving spouse. So if anything accrues to the surviving spouse in terms of the Matrimonial Property Act, then that is going to be allowed as a deduction. Okay. If you give any kind of art, book, or anything like that to the state for at least 30 years or more, so if you have lots of expensive art or rare books or something like that, and you let the state use it for 30 years, probably to put in a museum or something like that, you can take it out and allow it as a deduction. P just stops anything being counted twice, so just in case something was. And what I mean by that is if you own shares and you also own assets, it's going to stop the shares and the assets being included together. And anything that you give to your spouse is also going to be allowed as a deduction. Okay. Now, section 5 tells you how you have to value it. The key principle, the general principle here, is that all the assets are going to be put into your estate and they're then going to be sold by the executor. Whatever the executor is able to sell them for is what they are going to be valued at for estate duty purposes. So it's not the market value on the date of death, it's the value at which the executor can sell them for. Okay, the only difference is that if it hasn't been sold, okay, so it's simply just given to somebody else and it's not sold and they get the cash. If the asset is just transferred to somebody else, it'll be fair market value at the date of death. If it's a farm, as with donations tax, you use 70%. And then the one that's different, any unlisted shares, those are always at fair market value, even if they were sold and they get some other price. Unlisted shares are always at market value. So I'll say it once more. If the asset is sold, it's going to be what you sell it for. If the asset was transferred to somebody else, then it's going to be at fair market value. Remember, a farm will use 70% of that value. However, the one special one is unlisted shares. Even if they are sold, you still have to use fair market value. Limited interests are once again calculated by doing the 12% and then using the tables. Okay, the good news for you, you don't have to know how to value them. The amount will be given. But I put it there just so that you do know how it is done. Then we get something called an abatement. Every natural person is entitled to this. It's an amount of 3.5 million. And basically what this does is it says you can take off, once you've had all your property brought in, once you've had all your deductions, you can take off 3.5 million rand per person. This is taken off before you do the 20%, so it's not a rebate. Okay, it is in effect an allowable deduction. And once you've taken off the 3.5 million, you then multiply by 20%. Okay. What I say here at the bottom is I said it gets tricky when you have a spouse who was previously deceased, or possibly even multiple spouses who were previously deceased. A reason being, I just want to quickly go to the next one. Okay, that'll be fine. The reason I say this is that what happens is if one spouse doesn't use all of the 3.5 million, it passes on to the next spouse. So if spouse 1 dies, let's say they use none of the 3.5 million, the remaining partner is allowed to use their 3.5 million plus the 3.5 million of the other person. So they get 7 million. If the first spouse who died used, let's say, 1 million of the 3.5, then the remaining person, when they pass away, can use their 3.5 plus the 2.5 that's still left over. Now, this can get a little bit tricky when you've had multiple spouses, so you've been married a few times. It can also get tricky if you have multiple wives. Remember, customary law in South Africa lets you have more than one wife. The example I always use is Jacob Zuma. And in this case, you're not going to be able to use and just basically gather 3.5 million from each spouse. There's going to be certain types of apportionments. And for details of this, look in section 4 cap A and look at examples in the textbook. Okay, I'm not going to cover them in these lecture slides. They can get a bit technical, but please do have a look at section 4 cap A and what's in the textbook.